Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. Looking good for the markets today. We're still below that 22,500 mark, but a lot of individual parts which are moving around. So let's get started.
Quite a lot of stocks on the radar, especially the metal pack today. Our buzz shining away in today's trading session. But let's take a look at the headlines today. Stocks trade firm and steady with advances far outstripping declines. Metals and industrials are the big gainers, while telecom and IT are the soft spots. Midcaps relatively outperform.
Sand DLM surges over 6% on the back of good fourth quarter number. Net profit zoomed 80% and revenue jumped 30%. The management says margin will improve in FY25 and expects 30% CAGR in the next 3 years.
Tata Elxsi corrects after posting a weak set of quarter 4 numbers. Constant currency revenue declined 0.6% sequentially. Brokerages also issue bearish calls on the stock. JP Morgan cuts the target price to 5,800 rupees a share, while HDFC Securities maintains its sell rating.
361 WAM gains after its earnings beat analyst expectations in the fourth quarter. Revenue grew by 31% and the net profit is up 24% on a sequential basis. Brokerage, Jefferies and Citi also initiated coverage with bullish calls on the stock.
Chennai Petroleum rallies on the back of a good set of fourth quarter numbers. The company saw over 53% growth in EBITDA and a revenue growth of 2%. The company also announced a dividend of 55 rupees a share.
Okay, all right. Those are the top headlines that we are tracking for the markets. It's a 77-point gain on the Nifty as we speak. Midcaps are firing through, and those pockets are doing really well. So the Midcap index is at that 50,000 mark, 0.7% higher there, and the Bank Nifty is the one which is pushing the Nifty higher as well. That one is up to 45 points. Some pockets doing well. We've been talking about a lot of earnings from the broader markets as well. And as Vic mentioned, metals pack, that is doing well, but IT has been seeing some pressure.
That's right. So IT, every time after the results, there's either been a revenue miss or a margin miss, and on the back of that, stocks are seeing exaggerated, sell-offs that we're seeing. But, the one index that we must look at is the Nifty Metal Index, up almost 2.5% in the session today. All of the components doing very well in the session. But I'm sure Hormaz will have a lot of metal stocks in his radar as well. This is our segment, Midcap Movers. Hormaz will take us through the midcaps that are moving around in the session.
Plenty of stocks indeed, and metals will be a part of it, of course, but we'll start off with some of the gainers that are surging ahead in today's trading session, and I'll start off with MRPL, and those gainers will come up on your screen now. 11.5% higher on MRPL, a sharp surge there. Panda Platforms, Biocon has broken above its 50-day moving average in today's trading session. ACC and Ircon International are also doing well. A sector that is doing well today is the fertilizer stocks, and FACT is leading the pack there. But the fact of the matter is that FACT barely has any float in the market, so we need to be a little careful there. Chambal Fertilizers, GNFC, RCF is at the day's high, now up 5%, also seeing good gains there. As Vivek was highlighting, metal stocks, all 15 constituents of the metals index are trading with gains today, and SAIL is the top gainer in that list, 7% higher now on SAIL. NMDC, JSPL, Nalco also doing very well for themselves in today's trading session. Some earnings reactions, some of them were reported today, some after market hours yesterday, and Chennai Petro is topping the charts now, 17% on Chennai Petro. Sonal will speak more about that. 361 WAM as well, 5% higher, but MCX and Tata Elxsi not doing well after their respective earnings. Some stocks that are doing well on the back of heavy volumes, and Aegis Logistics is topping the charts there, 11% higher now on very strong volumes. Data Patterns and Bharat Dynamics, in fact, the entire defense space is also doing extremely well in today's session, both of them trading with gains of around 7 to 8% on extremely strong volumes. And lastly, some underperformers of today, Vodafone Idea is seeing some profit booking after the surge that we witnessed yesterday, 7% lower. Another lower circuit for Spark, more share orders pending at that lower circuit, so we'll keep an eye out on that. Aster DM, and finally some profit booking seen in Exide and Amara Raja as well. Back to you.
Okay, finally some profit booking that we're seeing in those battery stocks, but let's take that forward because Chennai Petroleum is the one that you spoke about. It is rallying in trade today. The quarter 4 numbers, they were good. This is of course our midcap spotlight segment as well. If we look at the numbers, it is a good set. Revenues are up 2% on a quarter-on-quarter basis. The EBITDA has gone higher by 53% for the company. company, and this has come in after a very weak set in quarter 3. If you look at the margins as well, at 5.88%, that compares with 3.91% that the company has done in the quarter gone by, and profits are up accordingly by 72% to come in at 628 crore rupees. This again on the back of a very low base, and also because refining margins globally also improved on a quarter-on-quarter basis. The benchmark GRMs came in at $7.9 per barrel, and for Chennai Petro, it was at those levels, $7.7 per barrel, which compares with negative margins that the company made in the quarter gone by. If you talk about margins, they are still not back to their quarter 2 levels, because quarter 2 saw exponentially high GRMs for the entire industry. So they are still lower than those levels, so back to that quarter 1 level. But Street is cheering the fact that they've done well, and also additionally the company has announced a dividend of 55 rupees a share, which is a dividend yield of 5.2%. On the back of this, MRPL is also higher. The refiners are happy, standalone refiners, that this quarter has been good in terms of refining margins.
Well, very well pointed out, very strong dividend yield, like you mentioned, and no wonder the stock is spiking up in the session. We have a very interesting conversation lined up for you. Goldman Sachs remains bullish on the power sector stocks such as Power Grid and Hitachi Energy. The brokerage also says that the Indian transmission sector will have the second largest share with more than $500 billion of spends. We have Nikhil Bhandari, the head of Asian Equity Research and co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs, to discuss further. Good afternoon, and it's an excellent note. We had a chance to go through it. First up, give us a sense of how is the power sector outlook according to you. What kind of spends are you seeing? If you could break it up, maybe first for the next decade, and which themes, according to you, are the sectors to look at?
Sure. Thank you so much for having me on the show. So just to give a bit of context, we started a more dedicated research on clean energy sector in India last year. We highlighted how round-the-clock renewables are a critical but not a sufficient solution to India's challenge of balancing economic growth with decarbonization. We also highlighted how India's global leadership in renewables cost is driven by not just by natural factors like sunlight hours or the wind speed. It is also driven by its fully integrated national grid. Now, so building upon that, in the report that you mentioned, we put some more numbers to it. We believe nearly 1/3 of the overall energy transition capex required is going to be going towards the power transmission complex. In terms of billion, by 2050, we expect the total energy transition capex to be about $1.7 trillion, and out of that, roughly 30%, which is over $500 billion, will be allocated towards the power transmission sector. So, in terms of how do we think about the companies and the developers in this space, we are focused on we're looking at companies with larger balance sheets, relatively lower cost of debt, and companies who have the cutting edge transmission equipment technology. So those are the key areas that we have covered in the report, but I'm happy to go into different aspects in more detail.
Oh yes, Nikhil, and I know you will not be able to talk about specific stocks, so let's keep it at macros and understand what, according to you, in the renewable side of things, will be seeing capacity addition on an annual basis. What kind of levels are you envisaging there?
Sure. So if you look at the renewables sector today in India, roughly the run rate of capacity addition per year between solar and wind has been in total 15 to 20 gigawatt per year. We believe this run rate could nearly double by the end of the decade to 30 to 40 gigawatt addition. These numbers I'm talking about more at the grid level. Outside the grid, we believe there is an opportunity of in total about 400 gigawatt of renewable capacity that can be deployed for the requirements of corporate and industries decarbonization, C&I, as well as the agriculture solarization. So at a grid level, we are at 15 to 20 gigawatt. We go to 30 to 40 by the end of the decade. This totals up about 400 gigawatt at a grid level by the end of the decade. Outside the grid, there is another opportunity of 400 gigawatt in the C&I and the agriculture space.
Nikhil, first of all, just as we get into and as we aggressively ramp up renewables, like you just mentioned, let's also touch upon how exactly are you expecting thermal capacity addition. And do you see any opportunities there also for some of the listed players? Of course, you can't name names because given the fact that India has consistently over the past year and a half gone ahead and increased the thermal capacity addition guidance. So the latest number that's come out is almost 88 gigawatt of thermal capacity guidance. So would you also feel that some of the names earlier which were written off, some of the capital goods companies, some of the companies that are making equipment for capital goods, is that also a way you feel that we can look at playing this particular theme?
Sure, that's a great question. So the government recent target on a cumulative basis to 2032 is closer to 88 gigawatt of coal capacity addition, coal-based power plant capacity addition to come through. If you look at that number, there is about 30 gigawatt, which is already under execution. In order to hit that 88 gigawatt number, we think ordering needs to happen in the next couple of years, because after that, we need a few years for environmental clearance, land acquisition, PPAs to be signed, and then build up of these power plants. In our view, even if we achieve 70 to 80% of these goals by 2032, we still think there will be a net power supply demand deficit in the system because the electricity power demand has been growing at a very rapid pace. So one of the themes we've been highlighting last year is that there will be a revival in the thermal power plant capex cycle. That will benefit the power generation companies because on one hand, we do think round-the-clock renewable is an attractive solution, and that will become critical in terms of India's power sector. But at the same time, given the pace at which electricity demand is growing, we will need a lot more thermal coal capacities as well, and that capex cycle has already started last year. So again, both round-the-clock renewable and thermal will take the front seat here in terms of the capacity addition, and companies developing these areas of power will be the key beneficiaries.
Okay, so Nikhil, within renewables, which do you think is best suited to aggressively add capacity? What kind of returns do you see there? Is it better to add capacities in the thermal direction or renewables?
Sure. So look, solar-based renewables are already quite attractive on the power cost curve in India. The cost to generate solar power is nearly 2 rupees per unit of electricity versus the industrial customers are today paying 6 to 8 rupees per unit. However, solar is intermittent. If you want to make it round the clock by being creative, adding solar plus wind plus some storage, or make it solar plus a lot of storage, either way, to get a round the clock 24/7 electricity, we can still compete in the power cost curve because those RTC, round the clock renewable project, are costing about 4 to 5 rupees per unit. And with these RTC projects, we believe the IRR could be closer to 20%. So for plain vanilla solar projects, which are intermittent, do not fully solve the power deficit situation, the equity IRR has been slowing to low teens. But for round-the-clock solar with either wind plus battery solutions that can guarantee 24/7 power, the returns are more attractive at closer to a 20% equity IRR.
Right. Nikhil, one more question from our end. You've said, and you've distilled the amount that India's power transmission capex is expected to be almost $500 billion over the next 25 years. Can you distill that us, further in terms of, what will be the power transmission player? Mostly in India, it has to be, the beneficiary has to be Power Grid. Now also coming lower to names like Hitachi and some of the names, of course, you cannot speak individual companies, but what will be the pie that they will be able to get? And also one word on smart metering opportunity, because that too is something that there is quite a lot of spends currently on.
Sure. So again, I'll not talk about the stocks individually, but in terms of the overall transmission capex opportunity, we are talking about $500 billion plus by 2050. There are three main components to it. One is the capex that will be required just for the grid level of the renewable capacity, which we expect even after 2030, we expect additional 900 gigawatt of renewable deployment by 2050. In total, that itself needs about capex of close to $350 to $400 billion. On top of that, we believe there is a CNI, corporate and industrial decarbonization opportunity that conversion of gray to green power will require additional about $50 billion of capex. And lastly, the green hydrogen, where we expect 43 million tons of green hydrogen capacity by 2050, partly for domestic market, partly for export. Given the biggest cost to make green hydrogen is electricity, and we need round-the-clock clean green electricity to make clean green hydrogen, that will require additional about $90 to $100 billion of capex. So again, this is how we are building up the capex TAM. Of course, in the report, we have distilled it further into how much is it for just the grid equipment level, the medium distribution line and the high voltage distribution line. But that's how we have built up the addressable market. In terms of the smart metering, we haven't written anything published around it. It is still broadly at an early stage, so we haven't tamped it up in terms of the addressable market. I think the bigger opportunity at this point, based on our work, lies in the transmission grid and the equipments related to that.
Take that point, Nikhil. It was a pleasure having you with us on the show, and we'll speak again when you have an idea on the smart meter opportunity as well. So that calls for another conversation. We'll do one thing. We'll slip into a break now. When we return, we'll be joined by the management of Nelco to discuss their Q4 numbers. Stay tuned. Welcome back. You're watching Midcap Radar on CNBC-TV18. It's time to focus on Nelco. The stock is lower in trade on the back of its Q4 numbers. Revenues and EBITDA margin contracted on a YoY basis. To discuss this and the opportunities going ahead, what is the business outlook? We are joined by Mr. PJ Nath, the MD and CEO of the company now. Mr. Nath, good afternoon. Thank you so much for joining us. Q4 has been slower than your earlier quarters. The growth in terms of revenues is not there, actually. It's down 2% sequentially, down 0.5% on a YoY basis. What led to that? Is there any particular reason here?
Yeah, so while you look at a quarter, I think we would like to talk more on a year basis, because the quarters are not exactly the representation of how the business goes. It depends on some of the larger projects getting implemented in that quarter, etc. So therefore, if you look at from a year perspective, our revenue has grown by about 2%. But what is important is that our profits have grown by 20%. And overall, the company has become much healthier. Our operational efficiency has gone up. Our ROC has gone up to 29%. The balance sheet much more healthier. Debt equity ratio has gone down to 0.28. So overall, I think as a company, we have done well. The revenue has not grown the way we expected, because of some of the newer projects which are supposed to have come have got delayed due to certain market factors, which will come in this year. So we are not overtly worried about the top line not having grown the way we wanted, because the rest of the parameters of the company have been very healthy.
Mr. Nath, you've mentioned that you've not seen revenue growth to the extent that you wanted. Internally for FY24, what was it that you're working for? At the end of the year, you have a revenue growth of close to 2.2%. You alluded to a fact that few of the deals didn't really start off. Would you have a sense? Could you give us a sense of which of the deals that didn't kick off? And FY25, can we see resumption of some of these deals?
Yeah, so I don't know. We don't specifically talk of deals. To that extent, I'll not want to talk of specifically the deals. But yes, to answer your questions, yes, the revenue in FY25 would be significantly better than FY24. Although we don't give any guidance, and therefore I will not talk of any specific number, but it will be definitely better than that. As I said, it happened because of certain large projects not coming at the time that we were expecting, but they are on track, and that will happen in this year.
Okay, so you cannot give us a quantitative number. Your FY23 growth was 20% in terms of revenues. Your FY22 growth was 15%. Do you think you'll be able to do that number?
As I said, I don't give specific numbers, but yes, we are very bullish on FY25, and FY25 will be significantly better than what we had FY24.
Even in terms of margins, Mr. Nath?
Yeah, margins, our EBITDA margins have remained at about 90 to 20%. That has remained. Our profit margins have gone up. Our profit growth is much healthier. Our debts have come down significantly. Our debt equity is 0.28 against 0.43 last year. And so these are very important parameters that we consider. ROC, as I said already, it's about 29%. So overall, the company has become much healthier. We have invested in more capacities. So we've grown the capacity by more than 23%, but that happened towards the end of the year. And we are still in the process of increasing capacity, and all of that will start paying off in FY25. So therefore, we are fairly bullish. The company is healthy, and we are able to make investments. And I think that's what we are looking for. We are in the long-term game. And from a long-term perspective, I think we are in a pretty good state right now.
Right. Mr. Nath, now a couple of questions. First up, could you, give us the debt figure for us as well, how much it has come down by? And the second question is for FY25 and FY26, where is the revenue funnel that you're seeing from? Is it coming from in-flight services, maritime connectivity, or is it coming from the satellite policy? Where do you see, or how do you see the revenue mix panning out?
See, we are, let me answer the revenue mix part first. We are, we are operating in enterprise, aero IFC, and maritime. And we see the growth in all of them. In fact, for FY24, our IFMC, that is aero IFC and maritime, grew by 20% over the previous year. So that has gone fairly healthy. For FY25 and FY26, we see growth there as well as in the enterprise sector. You talked of the new space policy. The new space policy is making the market far more open. It is deregulating, and therefore, that, to my mind, will give boost to the market. It is becoming easier to do business, but a full impact would not be seen in FY25. To my mind, that will go till FY26. But overall, the policy framework has improved. The telecom bill has also come with a clear guideline that the spectrum for satellite would be administratively allocated, though we need to see exactly what the modalities of that would be. So therefore, all the regulatory parameters are all healthy. They are progressive. And so therefore, we believe that, and also the newer technologies coming, newer satellites coming, the cost of satellite capacity coming down, with that, we will be able to, we see the market moving much better than what has happened so far. Our current debt is around 20 crores, and that's what we have got right now.
And will you be able to see, will you see an increase in your debt because of the capex of the capacities that are coming by?
No, in spite of the increase in capacity, it is still 20 crores. But next year, yes, we've got large plan for making investments in capex this year. So therefore, we'll have to look at how the debt will go up or remain the same. But we are making investments in capex this year because we believe that there will be a lot more investment that will be required to address the growing needs of the market.
Thank you so much for your time, Mr. Nath. We wish you all the best for FY25. Now, as we slip into a short break, here's a programming note for our viewers. A Friday special offering, Editors Roundtable, is now coming at a new time. Catch the biggest market headlines of the week with expert analysts from market veterans and our own editors every Friday now at 3:30 p.m. Don't forget to tune in. Well, welcome back to Midcap Radar. Let's take a quick look at the markets. The Midcap Index and the Small Cap Index both trading the green. The Midcap Index continues to hold out above the 50,000 mark. Now, the other important sector to track today is the entire metals pack. The entire metal, the Nifty Metal Index is up over 2.5% and continues to climb higher. And look at the price move of some of these components. Have a look at SAIL, have a look at JSW Steel, have a look at Tata Steel, and also some of the other names, aluminum company players like Nelco and Hindalco. So it's been a very strong move as far as the entire metal pack is concerned today.
Oh yes, all the constituents are in the green today. But we'll do one thing with that. We'll take your leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.